Please like, share, and subscribe. Wishing you happiness and good luck every day.
Welcome to The Explainer. Today, we are going to tackle something huge, the stock market. And we're using Emil Collins' guide, Becoming a Stock Market Genius, to light the way. You know, if you've ever felt like the stock market is this, exclusive club with its own secret language, you are definitely not alone. It's a super common feeling, and this quote really nails it. It can feel like a total enigma.
Well, that all changes right now. In just the next few minutes, we're going to flip that script, turn that confusion into confidence. You ready? Let's do this.
Okay, so before we even get into the nitty-gritty of stocks and charts, we've got to start with the single most important question. Are you actually ready to invest? Is this the right move for you, right here, right now?
Okay, think of this as your personal pre-flight checklist for investing. Over on the left, you've got all the green lights, signs you're good to go. You've got an emergency fund, so a surprise car repair won't derail you. You're living within your means, and you actually have a goal in mind. But on the right, those are the big red stop signs. High-interest debt, that's a huge one. It's like trying to climb a ladder that's on fire. The interest you're paying on a credit card, for example, is almost guaranteed to eat up any gains you might make. And, really important, investing is a long-term game. It's not for money you're going to need for a down payment next year.
All right, so let's say you've checked all those boxes on the ready list. You're in a good spot financially. Now what? Let's get into the absolute basics. What in the world are stocks? And what is this market everyone's always talking about? We're going to build this from the ground up.
You know, at its core, this is actually way simpler than it sounds. A stock or a share, you'll hear both terms, is just a tiny, tiny piece of a company. So when you buy a share of, say, Apple, you're not just buying a number on a screen. You literally own a small fraction of the entire operation, the iPhones, the buildings, the whole shebang. And I absolutely love this pizza analogy on the slide. It's perfect. Imagine a company is a giant pizza. Each stock is just one slice. So when you buy a stock, you're buying one of those slices. You're becoming a part owner, and you get to share in its future success and hopefully its profits.
Okay, so where do you go to buy and sell all these pizza slices? Well, that's the stock market. You can think of it as a huge global auction house that's open for business every weekday, connecting millions of buyers and sellers in real time. So you own some shares. How do you actually make money? This slide breaks down the two main ways. First up, you've got capital appreciation. That's the one everyone knows. Buy low, sell high. The value of your slice of the company goes up over time. But the second way, on the right, is through dividends. This is pretty cool. It's when a company takes a chunk of its profits and just gives it back to its shareholders as a cash payment. It's like a thank you bonus for being an owner.
And here's the thing, not all stocks are the same. Just like cars, there are different types for different needs. Blue chips, those are your big, stable household names. Think of them as the aircraft carriers of the market, massive and reliable. Growth stocks are more like startups. They pour every penny back into growing the business as fast as they can. Tech stocks are your innovators, right? High potential, but they can be a roller coaster. And income stocks are all about those dividends we just talked about. They're designed to give you a steady cash flow.
Okay, so that's individual stocks. But what about the big picture? How do we take the temperature of the entire market? I mean, with thousands of different companies, how can you possibly know if it's generally a good day or a bad day out there?
So you've probably heard people on the news talk about bull markets and bear markets. These are just fancy terms for the market's overall mood. And here's a super easy way to remember which is which. A bull thrusts its horns up. That's a rising, optimistic market. A bear, on the other hand, swipes its claws down. That's a falling, pessimistic market. And that 20% number? That's kind of the unofficial line in the sand that separates a simple correction from a full-blown bear or bull market. But how do we even measure if the market is going up or down? We can't track every single stock, right? That's where an index comes in. An index is basically a snapshot, a small sample of stocks that represents the whole. It's like taking the market's temperature to get a quick reading on its overall health.
So when you turn on the TV and hear, the market had a great day, they're almost always talking about one of these three big ones. The S&P 500 is the big one. It tracks 500 of the largest companies in the US, so it's a really broad look at the economy. The Dow is a bit more old school and exclusive, tracking just 30 massive, influential companies. And the NASDAQ, well, that's the tech-heavy index. If you want to know how the world of innovation is doing, you'll look at the NASDAQ.
Okay, let's talk about what might be the single most important part of this whole conversation, risk. Because, look, while the idea of making money is exciting, there is no reward in the stock market without taking on some risk. And understanding that trade-off, that's what separates smart investors from gamblers.
And risk isn't just one thing. It comes at you from every direction. You've got headline risk. A single bad news story can tank a company's stock. Then there's legislative risk. A new law gets passed, and suddenly a whole industry is scrambling. Obsolescence risk is a big one. Remember Blockbuster? Their product just became outdated. And then there's inflation, the quiet one. It's the silent thief that can eat away at your returns, even when it looks like you're making money. A smart investor isn't scared of these risks, but they're definitely aware of them.
And that's it. In just a few minutes, we've covered the absolute essentials. You've gone from being on the outside looking in to having the core knowledge you need to start understanding how this all works. You've got the building blocks now. So the real question is the one on the screen. Now that you have this knowledge, what's your next move?
You know, when you think about investing, what's the #1 fear? It's not about picking the wrong stock, is it? It's just the fear of losing money, plain and simple. But what if I told you that embracing those losses, well, that's the real secret to winning? Sounds crazy, right? Let's dive in.
Yeah, I know. It sounds totally backward. I mean, think about it. From the time we're kids in school to our careers, it's all about avoiding mistakes, right? Failure is bad. But the stock market, it plays by a completely different set of rules. And really getting your head around this one question, well, it could literally change your entire financial future.
It doesn't matter what field we're talking about, sports, science, you name it, we always look for that master, right? The person who seemingly cracked the code. And investing is no different. We're always on the hunt for that one guru who just has all the answers. And when you get into the high-stakes world of the stock market, there's one name that just stands above all the rest. It's spoken with this special kind of reverence. This person has become the absolute gold standard, the ultimate benchmark for success. Of course, I'm talking about Warren Buffett, the Oracle of Omaha. I mean, when you think stock market genius, his is the first name that pops into your head. A man who built an absolute empire on decades of just legendary investing. Okay, but here's where things get really interesting. Let's peel back the curtain a little bit on this legendary guru, because we're about to uncover a truth that, well, it might just surprise you. So this is the big question, isn't it? The one that honestly haunts every single beginner. You look at these titans of investing, these giants, and you just assume they have a perfect record. You think, man, if I can't be perfect like that, how am I ever going to succeed? And that thought, it's absolutely paralyzing.
Well, the answer is simple. It's powerful. And honestly, it's incredibly freeing. Yes, he loses. Even the master, the genius, he isn't perfect. Just let that sink in for a second.
And hey, this isn't just my opinion. It's a well-known fact. Even the guy we all hold up as the ultimate standard, the best in the business, is not immune to losing money on an investment. It happens. So with that in mind, let's officially tear down this myth of perfection. Because honestly, it's the single biggest mental roadblock that stops people from even getting started. This really lays out that mental shift we're talking about. On one side, you've got the myth, this idea that to win, you have to avoid all losses. It's like a dangerous tightrope walk, where one wrong step means you're done. But the reality? It's so much more like a sturdy bridge. It's okay to lose some of your investments. Sure, there might be some cracks here and there, but the path forward is totally secure. Losses are just part of the journey. Okay, so that's the million-dollar question, right? If losing is just part of the game and even the best of the best are taking hits, then how does anyone actually win? What separates the billionaires from everyone else? Well, that brings us to the real heart of this whole thing. It's time to forget about being perfect. Let's talk about the real winning formula. And here it is. This is the key. You want to earn more than you lose. It's not about avoiding losses altogether. The goal isn't a perfect score. It's just to make sure that, over the long run, your wins are bigger and more frequent than your losses. It's really that simple. So it's not about achieving a perfect score. It's all about net profitability. Think of it like a baseball player. A Hall of Famer might only get a hit 3 out of every 10 times at bat. They fail more often than they succeed. But it's those home runs, those big wins, that make them a legend. Investing is the exact same way. It's your overall net profit that matters, not winning every single trade. All right, so now that you get the real formula, the big question is, what do you do with this information? Let's talk about the most important part, taking that first step. So really, what are you waiting for? I see it all the time. People stay on the sidelines for years, trying to learn absolutely everything, trying to craft the perfect plan before they invest a single dollar. But we just learned that a flawless plan, well, it doesn't even exist.
You see, the biggest thing holding you back isn't a lack of money or some secret strategy. It's fear. It's the fear of losing. But by simply accepting that losing is part of the game, you've just torn down that entire barrier. This mindset shift, that is the key to getting started.
And that leaves us with one last, really important question to think about. If losing is just a part of the game, then what's the first rule you need to learn? Because the game isn't about avoiding losses anymore. It's about managing them. And that, right there, is where your real journey begins.
All right, let's jump right in. We're going to tackle a huge question that pretty much everyone asks themselves at some point. Is now the right time for me to start investing? It's a massive decision, right? So we're going to break it all down. The signs that say you're ready, the red flags that say you're not, and the risks that, well, everyone has to face. Let's get into it.
So first things first, let's just challenge a really common belief. A lot of us think the absolute safest thing you can do with your money is just to park it in a savings account. I mean, it feels secure, doesn't it? But, the reality is, it's a bit more complicated than that.
Because here's the thing, even that safe money isn't really safe from two invisible forces that are always at work: inflation and taxes. Over time, inflation just quietly eats away at what your money can actually buy. And of course, taxes can take a chunk out of whatever interest you earn. So while your money isn't at risk in the market, it's slowly but surely losing its power. And that's really the whole reason people start looking into investing in the first place.
So if just saving isn't the whole answer, then what does a prepared investor actually look like? Let's start with the green lights, all the signs that suggest you are genuinely ready to take that leap. This first part of our little self-assessment is all about having the right reasons and, maybe more importantly, the right mindset.
Let's start with your why. What's really driving you to do this? Some of the best signs that you're ready are things like wanting to build another stream of income, or maybe you just want your money to work harder for you. And it's not about having a ton of cash to start with, it's about wanting that money to grow. If you know exactly what your goals are and you see investing as the right tool for the job, that's a huge positive sign.
Now, this is where it gets really interesting, because successful investing isn't just about what's in your bank account. It's about what's in your head. It's about your temperament. Can you stay cool and objective when the market inevitably takes a nosedive? Can you trust data instead of your emotions? And maybe the hardest part, can you be patient enough to let your strategy play out over years, not days? These traits are absolutely crucial.
And this quote right here, it just nails it. Winning and investing isn't about getting lucky or chasing the hot new thing. It's about having a plan you've actually researched and then having the discipline to stick to it. Guys like investor Tim Sykes really show that a solid, consistent strategy is what separates the pros from people who are just, throwing darts at a board and hoping for the best.
Okay, let me ask you something a little different. Are you the kind of person who actually enjoys a good challenge? Maybe you like games that involve a bit of strategy and risk, something like poker. That could be a good sign you have the right kind of mindset for the market. But, and this is a really, really important but, there's a world of difference between taking a calculated risk and just straight-up gambling.
And this is the absolute key distinction we have to make. Investing is all about calculated risk. It's based on research, on data, on having a plan. You know what the potential downsides are, and you have a strategy for them. Reckless gambling, that's all impulse and emotion. It's hoping for that one big score. If you're looking at the stock market like it's a casino slot machine, that is a massive sign you are not ready.
Okay, so we've talked all about having the right mindset. But hold on, before you get too excited, we need to hit the brakes and have a serious reality check. Because honestly, even if you have the perfect investor personality, there are some financial boxes you absolutely have to tick first. These are non-negotiables.
The very first number you need to be aiming for is zero, as in zero high-interest debt. I'm talking about credit card balances, personal loans, that kind of thing. Just think about it. The interest you're paying on that debt is almost always way higher than any return you could realistically expect from investing. Paying off your debt is a guaranteed risk-free win. It just makes no sense to invest while that's hanging over your head.
All right, the next magic number is 6, as in 6 months.
Before you even think about investing, you need to have at least 6 months' worth of your living expenses tucked away in an emergency fund that you can get to easily. This is your financial firewall. If you lose your job or your car breaks down or you have a medical emergency, this fund is what stops you from having to sell your investments at the absolute worst possible time.
Next question, and be honest with yourself on this one. Do you have a spending plan? A budget? Do you actually know where all your money is going every single month? If you don't have a clear picture of your own finances, you're just not ready. You have to know exactly how much you can truly afford to invest without messing up your day-to-day life.
This little table shows you the proper order of things. Think of your money like a waterfall. Your income comes in at the top. First, it covers your daily living expenses. Then, you fill up your emergency fund for safety. After that, you put money toward big, long-term goals like retirement. And investing? That's for the money that's left over after all those other buckets are full. It's for growth, not for paying this month's rent.
And here are a few other absolute deal breakers. No health insurance. One medical emergency could wipe out everything. If you're with a partner, you have to be on the same financial page. And if you're trying to invest to pay for a vacation next year, that's a huge red flag. You're treating the market like a savings account, and it's just not designed for short-term goals like that. It is a long-term game.
All right, so let's imagine you pass the test. Your high-interest debt is gone, your emergency fund is full, you've got the right mindset, you're ready. But just because you're ready to step onto the field doesn't mean the game isn't dangerous. Now we have to talk about the battlefield itself, the risks that every single investor, no matter how prepared, has to face.
First up is something called headline risk. This one's pretty easy to understand, but it's powerful. It's the danger that a single bad news story can totally tank a stock's price, even if the company's business is actually doing fine. In our 24/7 news world, one negative story can set off a chain reaction that hurts a company, an entire industry, or even the whole economy.
And a perfect chilling example of this is what happened after the Fukushima nuclear disaster back in 2011. The news didn't just hurt one company. It absolutely hammered stocks in any industry, even remotely related. Uranium miners, utility companies, you name it. They all got punished because of the headline, which just goes to show how events out of anyone's control can create these massive ripple effects.
Okay, this next one is a little bit scarier, honestly. It's called model risk. This is the risk that the fundamental economic models and assumptions, the super complex math that the entire financial world relies on, are just plain wrong. When the models that are supposed to predict risk fail, the whole system can start to fall apart like a house of cards.
And if you want to see what that looks like in the real world, you don't have to look any further than the 2008 financial crisis. That was a textbook case of what happens when the models designed to measure risk in the mortgage market just completely and utterly failed. It's a powerful reminder that even the systems built to protect us aren't foolproof. And trust me, the list of potential dangers goes on and on. You've got the risk that the price of raw materials will suddenly change, the risk that a company's amazing product becomes obsolete overnight, or the risk that the government passes a new law that totally changes the game. And then there's fraud, and of course the ever-present risks of inflation and changing interest rates.
So, what's the big takeaway from all this scary stuff? It's summed up perfectly in this quote. There is just no such thing as a risk-free investment. It doesn't exist. Risk is part of the deal. The goal isn't to get rid of it, because you can't. The goal is to understand it, manage it, and make smart decisions anyway.
So, we've come full circle. We've looked at the mindset you need, the hard financial rules you have to follow, and the universal risks you'll face on the battlefield. Which brings us back to the original question, but this time it's for you. Knowing what you know now, where do you stand?
Every investor keeps an eye out for the obvious stuff. A bad earnings report, maybe a new competitor on the scene. But what if the biggest threats to your portfolio are the ones you can't even see? In this explainer, we're going to pull back the curtain on those invisible forces that are quietly working behind the scenes, shaping your financial future. So what are these hidden dangers we're talking about? Look, this isn't just about small market ups and downs. We're talking about huge economic pressures and, maybe even more surprisingly, some deep flaws in the very tools we all trust to make sense of the financial world. Let's start with that big picture. All right, first up is this massive threat, the economic squeeze. And this is a force that puts pressure on absolutely everyone, from the biggest corporations all the way down to you and me. It's a reality every single investor has to figure out how to navigate. What this creates is a really dangerous situation, a kind of double bind. See, on one side, you've got businesses getting slammed with higher costs for everything from materials to labor, which of course forces them to jack up their prices. But on the other side, you have consumers who are getting squeezed by inflation, leaving them with way less money to spend on those now higher-priced goods. So what happens? Businesses can't sell as much at those higher prices, and consumers just can't afford to buy. The result? Well, the entire economic engine just starts to slow down. It's really a classic recipe for a struggling economy, and it creates this powerful and pretty dangerous feedback loop. And this can all spiral into a real worst-case scenario, something called stagflation. It's this toxic cocktail where the economy just stalls out, but at the same time, prices and unemployment just keep climbing. For investors, it's pretty much one of the toughest environments you can possibly imagine. But, these big economic pressures, they're really only half the story. There's another risk, one that's a lot more subtle and honestly maybe a bit more frightening, lurking just beneath the surface. And that's the danger that the very tools we use to understand the economy are just fundamentally broken. This is what's known as model risk. Think about it like this. Imagine a weather forecast that's built on a totally faulty premise. Like, say, it assumes the wind only ever blows from the north. Every single prediction it makes would be wrong, right? Well, in finance, when the models that are supposed to predict risk are broken, the consequences aren't just a ruined picnic. They can be catastrophic on a global scale. And this creates a devastating domino effect. It all starts with one bad assumption in a model. Then the businesses that are relying on that flawed model start to suffer. Then the partners and companies who rely on them start to fail. And before you know it, a chain reaction is just ripping through the entire system. Okay, so I know what you might be thinking. This all sounds a little abstract, doesn't it? Is this just a theory, or does this kind of thing actually happen in the real world? Well, unfortunately, we have a very clear and very painful example. The 2008 financial crisis, that was a textbook example of model risk blowing up in our faces. The incredibly complex models they used to rate those mortgage-backed securities, they were basically built on a house of cards. They fundamentally misunderstood the risk involved, and when they failed, the dominoes fell across the entire global economy. So, we've talked about economic pressures, we've talked about broken models, and yeah, it sounds pretty grim. But here's the thing. Just being aware of this stuff is the first step toward building a defense. So, let's open up the investor's playbook. How can you actually turn this knowledge into an advantage? The first and honestly the most important rule in the entire playbook is this. There is no such thing as a truly risk-free investment. Period. Anyone who tells you otherwise is selling something. Just accepting that fact is the absolute foundation of smart investing. And this really gets us to a few core principles. Look, every investment has some risk, both the big universal ones we've been talking about and others that are totally unique to that specific asset. But the key thing to remember is that the potential rewards can still be worth it. The goal isn't to somehow avoid all risk, it's to price it correctly by understanding it first. And that's really the central message here. You can't just wish risk away, but you can absolutely arm yourself with knowledge. Understanding that big economic picture and learning to question the models that everyone else just takes for granted, those are your most powerful tools. It's what turns fear into actual preparedness. And finally, there's one last piece of, let's call it practical advice from our source. After all the research, after all your due diligence, you still have to be prepared for the ride. Investing just means accepting a certain amount of uncertainty. So do your homework, understand these invisible forces at play, and as the author suggests, maybe keep a bottle of whiskey and a stress ball nearby. Thanks for listening.
Welcome to The Explainer. Today, we're going to break down one of the most powerful and maybe one of the most misunderstood tools for building wealth in the entire world, the stock market. We're going to strip away all the jargon and really demystify it, step by step, so you can see exactly how it all works. So let's kick things off with a real problem that a lot of successful small businesses run into. Imagine you've built something great, it's growing like crazy, and you realize you need $1 million to hit that next level. But maybe a bank loan isn't the right move, or maybe it's not even an option. So what do? Where does that money come from? To really get a handle on the stock market, we're going to follow a little story. It's about a fictional entrepreneur. Let's call him Joel. His journey, from a tiny candy maker to a big public company, is honestly the perfect way to see all these concepts in action. All right, so this is Joel. He started his company, Candy Corp, with just $3,000 and an old secondhand machine. I mean, we're talking really humble beginnings. But he worked hard, and 5 years later, his business is absolutely booming. He's got lines out the door.
Everybody wants Candy Corp's stuff. The problem is, to keep up, Joel has to get bigger. He needs new equipment, he needs to hire more people, he needs a bigger factory, and all of that takes cash he just doesn't have on hand. A cool $1 million to be precise. So Joel's at a fork in the road. He could go to a bank and take on a bunch of debt. Or he could try something different. He decides to offer the public, people like you and me, a chance to own a small piece of his company, Candy Corp. And that one decision, that is the key to understanding this whole thing.
And this right here brings us to the most basic building block of the entire stock market. Joel is selling pieces of his company, right? But what are those pieces actually called? And what does owning one really mean? Okay, so in the simplest possible terms, when you buy a stock, you are literally buying a tiny piece of that company. You become a part owner. So let's say Candy Corp creates 100,000 of these pieces, or shares, and you go out and buy 10,000 of them. Well, congratulations. You now own 10% of the entire company.
You know, the pizza analogy is just perfect for this. Seriously. If you own one slice of that pizza, you own part of the whole thing. The crust, the sauce, the cheese, everything. It's exactly the same with a stock. You own a piece of everything the company has, from its factories and its cash to its brand and hopefully its future profits.
Now, for Candy Corp to actually sell all those slices to everybody, it has to go through this huge process called an initial public offering. You've probably heard it called an IPO. This is the big launch event, the first day its stock is available, and it's how the company raises that $1 million from all these new investors who believe in what Joel's building.
Okay, so Candy Corp stock is officially out in the world, and thousands of people now own it. But what happens next? Where do they go if they want to buy more shares, or maybe sell the ones they have? They can't just call up Joel anymore. They need a proper marketplace for this stuff.
It really helps to think of the stock market as having two separate but connected parts. You've got the place where a stock is first born and sold by the company itself, and then you have the place where it lives out the rest of its life, getting traded back and forth between investors.
So that primary market, that's purely for the initial sale, the IPO. That's where Candy Corp gets its $1 million. But after that one event, all the action, all the daily trading moves over to the secondary market. That's where you and I would buy and sell Candy Corp stock from each other, and the company isn't directly involved at all. The price just goes up or down based on good old supply and demand.
And I'm sure you've heard of the big ones, like the New York Stock Exchange, the NYSE, and the NASDAQ. These are the most famous secondary markets on the planet. The NYSE, you know, it's famous for that iconic trading floor you see in movies, and is home to a lot of the world's biggest, most established companies. And then, NASDAQ is this huge all-electronic exchange, known for being the place where all the big tech giants are listed.
Okay, so just like Joel sells different kinds of candy, there are different flavors of stock out there. They're not all the same, and different kinds appeal to different investors for totally different reasons. We're going to look at two big categories, but just know there are a ton of others out there.
Our friend Joel's company, Candy Corp, is a classic growth stock. Instead of paying out profits to its new owners, it's plowing every single penny it makes right back into the business to get bigger, faster. So investors buy these hoping that the company is just going to explode in size, and the stock price will grow right along with it.
Now, on the complete other end of the spectrum, you have what are called blue chip stocks. Think of those huge, financially solid companies that are absolute leaders in their field. Their crazy fast growth phase might be over, so they often have a different way of rewarding their owners. They just share the profits directly.
Which brings us to the big question, right? The one you've probably been waiting for. How does owning these little slices of a company actually make you money? What's the end game here?
Well, when you boil it all down, there are really two primary ways you can earn a return on your investment. The first is if the value of your slice goes up, and the second is when the company literally hands you a piece of its profits.
The first one is called capital appreciation, and this is that classic saying you've heard a million times. Buy low, sell high. It's that simple. If you bought one share of Candy Corp for $10 during the IPO, and a year later, the business is doing so well that people are willing to pay $15 for it, you've made a $5 profit. That's capital appreciation. And that second way to make money is through dividends. Now remember those big, stable, blue-chip companies we just talked about? Well, when they have a good year and have a lot of extra profit, they might decide to just give some of that cash directly to their owners, the shareholders. That payment is a dividend. It's your cut of the company's earnings paid right into your account.
See, in the end, it really all comes back to this one simple but incredibly powerful idea: ownership. It doesn't matter if the stock price goes up or if you get paid a dividend. Both of those things are a direct result of the fact that you own a real piece of a real business.
So, when you get right down to it, understanding stocks means you're not just a spectator watching the world's most innovative companies from the sidelines. It means you actually have the opportunity to own a piece of their future. So the real question isn't just about investing. It's about what part of the world, what piece of the future do you want to own?
You hear it all the time, right? On the news. The market is up, the market is down. But what is that market? Like, really? Let's break it down and demystify one of the biggest forces in our global economy. Let's just start with a number: $50 trillion. That's a 5 with 13 zeros. That is the absolutely mind-boggling amount of money that moves through the world's stock exchanges every single year. So you gotta wonder, what kind of system can possibly handle that much value? Okay, to really wrap your head around $50 trillion, get this. It's actually more than the value of, well, everything the entire world produces and does in a whole year. Every single car, every cup of coffee, every app. The financial market is bigger than the real world market. It's like this massive parallel economy humming along right next to the real one. All right, so we've got the scale down, right? It's a system moving an absolutely insane amount of money. But how does it work? What is it, fundamentally? Let's dive into the core concept. You know, when you boil it all down, the definition is actually pretty simple. A stock exchange is just an organized marketplace where things like stocks get traded. Marketplace, easy enough, a place to buy and sell. But that word, organized, that's the real key here. It's the secret sauce. It means there are rules and systems in place to make sure it's not just, complete and utter chaos. Seriously, if you just strip away all the complicated jargon, that's what you've got. A giant, super organized market. But instead of picking up apples and oranges, you're buying tiny little slices of ownership in different companies. It's just a central place that's built to connect buyers and sellers as smoothly as possible. Okay, so we've got the abstract idea of a marketplace down. Now let's look at the most famous, most iconic real-world example out there, the New York Stock Exchange. The NYSE, it's not just famous. It's an absolute titan of finance. When you look at the sheer amount of money, the capital that flows through it, it's the biggest on the planet, period. It really sets the bar for everyone else. And get this, it's got some serious history. It was founded way, way back in 1792. That makes it older than a lot of modern countries. And that long, long history is a huge reason why so much trust is placed in it. So let's recap the highlights. We're talking Wall Street, Manhattan. Founded back in 1792, and it's the biggest in the world by the sheer amount of money it generates. Those are the big takeaways for this financial giant. All right, so we know what an exchange is, and we've got a world-famous example to picture. But how does the trading, actually happen? What's going on inside that machine? Well, it really boils down to two main ways it gets done. First, you've got the traditional way, through human brokers. These are the pros who are actually making the trades for investors. But now, the whole game is dominated by the second method, electronic systems. We're talking direct, super fast, tech-based trading that happens at speeds that are just hard to even imagine. So whether it's an actual person on a trading floor or just some algorithm whirring away in a server farm, all of that buying and selling happens inside one single, highly regulated system. And that's really the heart of it all. It's a massive, organized marketplace, built on a long history with clear rules, all designed to handle these incredible sums of money. So we've figured out what this marketplace is all about. But that just opens up the next big question, right? If this is the market, who actually gets to play in it? How does a company even go from being just a private business to having its shares traded by millions of people all over the world? Well, that's the next piece of the puzzle to solve.
All right, let's talk about the stock market. Today, we're going to break down the essential framework you need to understand what actually moves the market. Our goal? To help you go from feeling a little lost to being a truly informed observer of the game. Okay, let's jump right in. You've heard it a million times, right? On the news, they say the market is up 3% today. But have you ever stopped to think, what is the market? Which one are they talking about? It sounds like a simple question, but there's a bit more to it, and that's exactly what we're going to clear up right now.
Okay, so imagine you're about to explore a brand new country. What's the very first thing you need? A map, right? Well, in the world of stocks, our map is something called an index. You can think of it as the scoreboard for the entire market.
Right, so when you hear the market is up, they don't mean every single stock in existence. I mean, can you imagine trying to track all of those? It'd be impossible. Instead, they're talking about the performance of an index. It's just a hand-picked sample of stocks that gives us a really good snapshot of the bigger picture. Now, there are three main maps, or indices, you're going to hear about all the time. First up, the S&P 500. This is the big one. It gives you a wide-angle view of 500 of the biggest, most stable companies in the U.S. Then you've got the Dow Jones. It's older and way more focused, tracking just 30 absolute giants. And finally, there's the NASDAQ. If you're thinking tech, you're thinking NASDAQ. It covers over 3,000 stocks.
So why should you even care about these things? Well, they're super important for a couple reasons. For one, they give you a benchmark. It's how you can ask, hey, how did my investments stack up against the market average? They also help you manage risk, because by tracking a whole bunch of companies, they smooth out the crazy ups and downs of any one single stock.
Okay, pro tip here. And if you remember just one thing from this section, make it this. Always, always focus on the percentages, not the points. A 250-point jump on the Dow sounds massive, doesn't it? But when the whole index is at 25,000 points, that's just a 1% move. Percentages are the only thing that tell you what's really going on. All right, so we've got our map. We know how to read it. Now we need to understand the weather. Is it a beautiful sunny day for investing, or is there a hurricane on the horizon? In the market, we call this the climate. And it really boils down to two types of weather. First, you've got your bull market. Think charging ahead, full of confidence. Everyone's optimistic, they're buying, and prices are just climbing. And then you have the complete opposite, the bear market. This is when fear creeps in, people get pessimistic, and pretty much everyone starts selling, driving prices down. And look, a bear market isn't just one bad day or a rough week. We're talking about a pretty serious downturn, a drop of 20% or more that lasts for at least a couple of months. And they can stick around. On average, you're looking at about 13 months of this widespread pessimism.
So what kicks off a bear market? Well, a few things can do it. Economists start whispering the R word, recession, and investors start running for the hills. Or maybe the central bank decides to hike up interest rates, which is kind of like hitting the brakes on the whole economy. And sometimes, stocks just get too popular for their own good. They get way overvalued, and a correction becomes inevitable.
Okay, but what makes the weather change in the first place, right? Why does a sunny bull market suddenly turn into a stormy bear market? To figure that out, we need to go down into the engine room and see what's actually making this whole thing move. At its very core, it's actually pretty simple. It's just supply and demand. The entire stock market is basically one giant, fast-paced auction house. If a ton of people want to buy a stock and only a few people are selling, well, the price is going to get bid up, up, up. And the reverse is true too. Lots of sellers, not many buyers, the price has to come down to attract someone. Let me show you how this works with a quick story. We'll call it a tale of two pastas. On one side, you have Company A. They're the old-school, reliable pasta brand. Solid stock price, $100 a share. On the other side, you have Company B, a new startup with get this, an avocado sauce pasta. Their stock is trading at just $50.
And then the news breaks, and everything changes. Suddenly, famous chefs are all over social media raving about this crazy avocado pasta from Company B. Demand just explodes. At the exact same time, a nasty story comes out about Company A, a health scandal. And investors, they're totally spooked.
And boom, just like that, the game is flipped on its head. Everybody wants a piece of Company B, and that huge demand sends their stock price soaring all the way to $100. Meanwhile, people are dumping Company A stock as fast as they can, and the price just collapses. See? It all comes back to supply and demand completely fueled by new information.
Now, of course, it's not just about one company's pasta sauce. There are much bigger forces that can move the entire market. Think about changes in government policy, or inflation, or interest rate adjustments. All that stuff matters. And then you have the real wild cards. Political events, natural disasters, anything that creates uncertainty. Because if there's one thing the market absolutely hates, it's uncertainty.
Okay, so we have the map, the indices. We have the climate, the bull and the bear. And we have the engine, supply and demand. That's pretty much everything you need to know, right? Well, not quite. There's one more piece, the final, most unpredictable piece of the entire puzzle. And that piece is us. It's human beings.
And this is why predicting the market is so incredibly difficult. You're up against three major hurdles. First, nobody, and I mean nobody, has a perfect formula for what a stock is actually worth. Second, you can't predict those trigger events, that one piece of news that changes everything. And finally, and most importantly, at the end of the day, the market is just people.
And that right there is the absolute heart of it all. We can analyze spreadsheets and charts all day long. We can use all the logic in the world. But when it's your money on the line and it's time to actually hit that buy or sell button, emotion takes over. Fear, greed, excitement. We're not robots. We're human. And that human element creates the ultimate investor's dilemma. It's those questions that can keep people up at night. If you're out of the market, how do you know when the right time to get in is? And if you're already in, how could you possibly know when it's time to get out? It's the hardest part of the whole game. So, there it is. You've got the map, you understand the climate, and you know about the powerful forces, both the logical and the emotional, that make it all tick. The stock market really is this incredible mix of cold, hard data and messy human nature. Now you understand the rules of the game. So the only question left is, what's your next move? You know, it's easy to think the stock market is all about companies and their profits, but it doesn't exist in a vacuum. There are these huge external forces out there that can send it soaring or, well, sinking. So today, we're going to break down 4 of the biggest threats every single investor should have on their radar.
I mean, come on, we've all been there, right? You check your portfolio and it's just a sea of red. It can feel totally random, like the market just woke up on the wrong side of the bed. But what if I told you that a lot of those sudden drops aren't random at all? That behind them, there are actually identifiable patterns and pressures at play?
Yeah, the truth is, a lot of the time, these big market moves are just a reaction to what's happening in the wider world. You know, economic stuff, political events, even natural disasters. And understanding them is absolutely key. So let's dive in and break down 4 of the biggest ones you really need to watch out for.
Okay, first up is a big one. It's something that's been all over the headlines lately: inflation. Now, inflation is kind of this quiet force that can seriously eat away at your value if you're not paying close attention. So let's get into what it actually is. It's so easy to just think of inflation as, prices going up at the grocery store or the gas pump. But for an investor, it's way more insidious than that. What it really means is that the real value of your money, your returns, your dividends, is shrinking. Every dollar you have just doesn't stretch as far as it used to.
And this is where it gets really interesting, especially if you're an income investor. So think about it like this. When inflation goes up, those fixed cash payments you get from dividends, suddenly they buy less stuff. And that makes those traditionally safe income stocks look a whole lot less appealing, which can force investors to start looking for other places to put their money.
All right, so now let's flip the coin and talk about the exact opposite threat, which, believe it or not, can be just as dangerous: deflation. I know, falling prices, that sounds great, right? But for the economy and the stock market, it can be an absolute disaster.
So yeah, it's pretty simple, right? If inflation is too much money chasing too few goods, deflation is the complete opposite. But the consequences? Whoa, they are profound, and they can create this really nasty feedback loop.
And here is that downward spiral in action. See, when people start expecting prices to keep falling, what do? They stop spending. Why buy today what will be cheaper tomorrow? And that just crushes company revenues. Lower profits mean lower stock valuations, right? And that spooks investors, who then start selling off their shares, pushing the market down even further. It's a truly vicious cycle.
So there you have it. 2 sides of the same coin, and each one has the power to sink the market. Maybe the easiest way to think about it is like this. Inflation attacks the value of your returns, while deflation attacks the value of the companies themselves.
Okay, let's shift gears now. We're moving away from pure economics and into the human element. Because let's face it, the world is a messy, unpredictable place, and big political and social events can send shockwaves through the financial markets almost instantly. This is just a fundamental truth for investors. I mean, think about it. Markets absolutely thrive on stability and predictability. So when that gets threatened by political turmoil or war or social unrest, uncertainty takes over. And if there's one thing investors hate, it's uncertainty.
And this quote, wow, it uses a really sobering, real-world example to drive this point home. A massive shock to the system, something like the 9/11 attacks, it doesn't just have an unimaginable human cost, it has a massive economic one too. It can grind economic activity to a halt and just shatter investor confidence, which has a direct, immediate, and powerful impact on stock prices.
And what happens next is pretty predictable. This is the typical reaction. When fear takes over, investors don't want risk anymore. They want safety. So they pull their money out of the stock market, which they now see as way too risky, and they pile into assets like gold, which has historically been seen as a safe haven, a store of value during chaotic times.
All right, our final threat is maybe the most unpredictable of them all: natural disasters. I mean, these are events that can strike with little to no warning and have absolutely devastating consequences.
And the impact here, well, it's tragically straightforward. A hurricane, an earthquake, a tsunami, these events can literally wipe out infrastructure, destroy entire industries, and just halt economic growth right in its tracks. The cost of rebuilding is immense, and all of that uncertainty and economic damage gets reflected directly in the stock market. So after looking at these four massive threats, you've got inflation, deflation, political shocks, and natural disasters. I know, it's easy to feel a little overwhelmed, but here's the key takeaway, the most important part. Simply understanding these forces is what can give you a real edge as an investor.
And really, that's the bottom line. Look, you can't control these events. Nobody can. But you can be aware of them. You can understand how they work and start to anticipate how they might impact your investments. And that knowledge, that is your power. It's what allows you to make informed decisions instead of just reacting out of fear.
So we'll leave you with a question to chew on. Now that you know about these threats, as you watch the news and just look at the world around you, which of these powerful forces, economic, political, or natural, do you think holds the most sway over where the market is headed next? It's something to think about. Thanks for tuning in.
All right, let's dive in. Today, we're going to decode the stock market. We're going to take all that confusing jargon you hear on the news and turn it into simple, common-sense ideas you can actually use. Let's get to it.
You know that feeling, right? You're listening to a financial report, and it sounds like they're speaking a completely different language. If you've ever felt like you need a translator for all the talk about bulls, bears, bids, and asks, well, you're definitely not alone.
And it's true. The world of trading really does have its own language. But here's the good news. It's a language anyone can learn. Think of what we're doing here as your own personal dictionary for Wall Street.
So, here's our game plan. First, we'll cover the basic words of any transaction. Then, we'll figure out how to read the market's overall mood. After that, we'll get practical and look at how to place an order, understand what a stock is actually made of, and then wrap up with a quick tour of your investment options.
Okay, first up, the language of a trade. Let's get right down to the fundamentals, because every single transaction, no matter how big or small, really just boils down to two key ideas. And those two ideas are the bid and the ask. Honestly, think of it just like any negotiation you've ever been in. The bid is what a buyer puts on the table, and the ask is the seller's price tag. It's that simple. One person wants to buy, another wants to sell, and they're just naming their prices.
Now, that little gap between those two numbers, that's called the bid-ask spread. It's the negotiation space, happening in real time. For a deal to actually happen, a buyer has to come up or a seller has to come down. And this matters because for traders, that tiny spread is like an invisible transaction fee. The smaller the spread, the better, because it means it's cheaper to get your trades done.
So this all leads to two basic strategies. Going long is what most of us think of when we think of investing. You buy a stock, and you're betting that its price is going to go up. Simple enough. But going short, that's the complete opposite. You're actually betting that a stock's price is going to fall.
So how in the world does that work? How do you sell something you don't even own? Well, it sounds kind of wild, but here's the breakdown. First, you borrow shares from your broker. Then you immediately sell them at their current higher price. Now you wait. If you're right and the price drops, you buy those same shares back at the new lower price, return them to the broker, and you get to keep the difference.
Part 2. The market's mood. Okay, now that we know the basic actions, let's zoom out and look at the bigger picture. How do you tell if the market as a whole is feeling optimistic or, a little scared?
I'm sure you've heard these two thrown around. A bull market is when things are great. Prices are rising, people are confident. Think of a bull charging forward, full of energy. And a bear market? Yep, it's the opposite. Prices are falling, people are pessimistic, and it feels like a bear retreating into hibernation for a long winter. And beyond just bull or bear, we can get more specific. Volatility tells us how wild the ride is. Are the price swings huge or pretty calm? Liquidity is all about how easy it is to buy or sell something fast without your own actions messing up the price. And trading volume, that just shows you how many people are playing the game. High volume usually means there's a lot of interest behind a price move.
So you know the lingo, you can read the market's mood. Now for part 3, execution. How do you actually tell your broker what you want to do?
Okay, this one is absolutely crucial. You have two main choices. A market order is all about speed. You're saying, I want this stock right now, just give me the best price available. But a limit order is about control. You say, I will only buy this stock if it hits my price or a better one. The catch? If the market never gets to your price, your order might never happen. It's a classic trade-off, speed versus control.
You can also put a time limit on your order. A day order, pretty self-explanatory, is only good for that one trading day. A good till canceled order, or GTC, will just sit there, day after day, waiting for your price target to get hit until you decide to cancel it. All right, let's switch gears for Section 4, the anatomy of a stock. We've talked about the act of trading, so now let's put the thing we're trading under the microscope. What actually defines a stock?
The big one is market capitalization, or just market cap. The easiest way to think about it is this. It's the total price tag for the entire company. If you wanted to buy every single share out there, this is what it would cost. It's the quickest way to get a sense of a company's size. Are we talking about a massive giant or a small up-and-coming player?
And the math behind it is super simple. You just take the total number of shares a company has and multiply it by the current price of one share. So in this case, 1 million shares trading at $10 a pop gives you a market cap of $10 million.
Now, quick but important point. Not all shares are available to trade. Outstanding shares means every single share that exists. But the public float is the number that really matters to most of us. That's the pool of shares available for the public to buy and sell, because it leaves out the shares held by company insiders.
For our last section, let's pull the camera back one more time. We've been focused on individual stocks, but let's take a quick look at the bigger investment universe out there.
So here's a quick lightning round. Blue chip stocks. These are the giants, the huge, stable household names. Think reliability. Mutual funds are basically baskets of stocks and bonds that a professional manages for a group of people. ETFs are also baskets of stocks, but the cool thing is they trade all day long, just like a regular stock. And hedge funds, well, those are the complex, private funds that use more aggressive strategies and are usually for very wealthy investors.
As we start to wrap this up, I think it's so important to remember this key idea. This whole thing is a marathon, not a sprint. The real goal isn't just to score one big win, but to just keep learning, keep expanding your knowledge, and building your skills over time.
And everything we've talked about today, from bid and asks to bull and bear, from market orders to market cap, these are the essential building blocks. You now have the vocabulary, the basic tools you need to understand what's going on in the financial world. So the next time you hear one of those financial reports, it won't be a foreign language anymore. The question is no longer, what are they saying? The new question is, what are they really saying? Now that you speak the language, what will you start listening for?
Have you ever felt like the stock market is just this wild, crazy dash for cash? Well, today, we're going to flip that whole idea on its head. We're going to dig into why the real secret to success isn't a sprint at all, but a marathon. And you'll see how that one little shift in thinking can change, well, pretty much everything. So, let me ask you, when you picture a successful trader, what pops into your head? Is it some frantic race? The adrenaline rush of a super fast win? I get it. It's a powerful image, right? We've all heard the stories of instant fortunes. But is that really how it works? Is that the true path to success?
And let's be honest, that dream of making quick money is incredibly powerful. You see these stories about overnight successes, and it's so tempting to think, hey, maybe that could be me. That temptation is what pulls so many people into the market, just hoping to get that one big lucky break.
And here's the crazy part. It's not pure fantasy. I mean, you could literally pull out your phone, open an app, and buy a stock in the next 5 minutes. And you know what? You might even get lucky and make a quick buck. That instant gratification is right there, just a few taps away.
Okay,
But this is where we have to pause and ask the really important question. Is one lucky trade the same thing as building real, repeatable long-term success? Come on, can a strategy that's all about impulse and luck, can that really carry you through in the long run?
And that brings us to the core idea today, which is really just a huge shift in perspective. It's time to stop thinking about that chaotic sprint and start training for the marathon.
Just look at the difference here. It's night and day. The sprint approach, it's all about chasing those quick profits, which means you're taking on massive risk. Let's just call it what it is. It's basically gambling. But the marathon approach, now that's about building something that lasts. You're swapping out high risk for actual skill development. You're replacing gambling with smart, strategic trading. Honestly, they're two completely different sports.
And here it is, the one sentence to remember from all of this. Successful trading is a marathon, not a sprint. Just let that sink in for a second. That one idea completely changes the game. Your goal is no longer just a short-term gain, it's long-term mastery.
So if you're not just chasing immediate profits, then what is the goal? It's actually pretty simple. The real goal is to pour all your energy into expanding your knowledge and building your skills. The profits? Well, they become the natural result of all that hard work, not the thing you were chasing in the first place.
Okay, I know you're thinking, that all sounds great, but how do you actually train for this so-called marathon? Where do you even begin? Well, like building anything that's meant to last, it all starts with a solid foundation of knowledge.
We call these fundamentals your building blocks. Think of them as the absolute must-know terms and ideas that create a really sturdy base for everything else you're going to learn. Once you have these, you can approach the market with a plan, step by step, instead of just, throwing a dart at a board and hoping for the best.
It's kind of like climbing a ladder, right? You can't just teleport to the top rung. You have to start at the bottom. So step 1, you learn the basic terms. You learn to speak the language of the market. Step 2, you use that language to really get the big concepts. And then step 3, you can start to build your actual trading skills. See how each step builds on the last one? That's how you climb, with real earned confidence.
And let's be super clear here. This is not about becoming a walking encyclopedia overnight, but having a really good handle on the key terms is absolutely essential. It's like having a map before you start a long road trip. It just helps you see where you're going and move forward with purpose.
All right, so all of this is leading us to a really, really important conclusion. It completely changes what your first move should be if you're actually serious about this trading thing.
So what is your true first step? It's not opening an account. It's not even picking a stock. Your real first step is the commitment to learn. It's deciding that you're going to train for the race before you even get to the starting line. That right there is where the real journey actually begins.
And that's really the choice, isn't it? Trading that frantic, stressful sprint for patient, steady, strategic pacing. It's about respecting the process and playing the long game. So the only question left to ask is for you. Are you ready to run your marathon?
All right, let's talk about it. With everything going on in the economy, the stock market can feel, well, like a giant storm, right? But here's the thing. Is it a storm you should run from, or is it actually packed with opportunity? In this explainer, we're going to break it all down, the good, the bad, and the playbook you absolutely need for your own investor's journey. Okay, so let's just dive right into the question that's probably on your mind. In a world that feels so uncertain, does it even make sense to be thinking about stocks right now? And you know what? That's a totally fair question. I mean, you turn on the news, you see all these headlines about wild market swings, economic downturns. Your gut reaction is probably to just, play it safe. It can feel genuinely frightening. But here's where it gets really interesting. There's this powerful idea from the source material that kind of flips that fear on its head. It says that the very thing that scares most people away, all that volatility, is exactly what creates these massive opportunities. Think about it. Big price drops basically mean valuable companies are on sale. And if you're smart about it, moments like these, well, they can be a total game changer. Okay, so keeping that massive potential in mind, let's talk about the good stuff. What's the upside? What are the real powerful advantages of actually putting your money to work in the stock market? Well, the first big one, and this is maybe the most important, is fighting this silent enemy called inflation. Here's the deal. If your money is just parked in a regular old savings account, it's actually shrinking. Yeah, shrinking. The cost of everything goes up, which means the cash you have buys less and less each year. It's pretty much a guaranteed way to lose money over time. And this chart really paints a picture. Just look at the numbers. Historically, the stock market has averaged about a 10% return each year. Now, put that right next to the average inflation rate, which is around 3.22%. It doesn't take a math genius to see what's happening here, right? One of these is an engine for growth, and the other is just a slow leak in your financial bucket. So what does that actually mean for you? It means that even after you cancel out inflation, you're still looking at a potential gain of almost 7% on average. And that right there is the whole ballgame. It's the difference between your money just sitting there losing its power and your money actually working for you, building your wealth. And hey, it doesn't even stop there. The stock market gives you this whole toolkit of other perks. I'm talking about limitless potential for growth. I mean, a $10 stock could become a $100 stock. Stocks are also super liquid, which is just a fancy way of saying you can sell them and get your cash back in seconds. Plus, getting started is easier than ever, and you can get some serious tax advantages with accounts like a Roth IRA. And maybe best of all, it lets you diversify, so you're not putting all your eggs in one basket, like just real estate or something. All right, but let's be real. No adventure is all sunshine and rainbows. We have to talk about the dangers. To be a smart investor, you've got to know the risks and be ready for the challenges that are definitely going to pop up. So the number one thing you're going to face is something called market volatility. It's the big one. The market goes up, sure, but it also goes down, and sometimes it goes down hard. These wild swings aren't a bug, they're a feature. It's just how the market works. So you've got to be ready for that ride, both in your head and in your wallet. And this right here is so important. It all comes down to your mindset. If you're thinking short-term, trying to trade every day, those swings are going to drive you crazy. A crash feels like the end of the world. But if you're a long-term investor, your whole perspective shifts. You see downturns as just part of the journey. You know it's going to happen, and you see it not as a disaster, but just a bump in the road on a path that historically has always trended up. There are a couple of other major pitfalls you've got to watch out for. First, remember that 10% average return. It's just that, an average. It is absolutely not a promise for any single year. And second, you have got to watch out for fees. The companies that help you buy and sell stocks, the brokerages, they have to get paid somehow. And the source material is pretty blunt about it. Those fees can really screw you over if you're not paying attention. Okay, so we get the potential upside, and we get the very real dangers. So what do we do about it? What's the playbook? Let's talk about the actual practical strategy for navigating this whole thing wisely. Here we go. It really boils down to 4 key steps to lower your risk. First, think long-term. That's how you ride out all that volatility we just talked about. Second, when things get scary and the market drops, do not sell out of fear. You've got to remember that long-term mindset. Third, do your homework on brokerages to keep those fees as low as possible. And finally, number 4, diversify your investments. And let's just nail down what diversification really means, because it's so important. It's that old saying, right? Don't put all your eggs in one basket. Simple as that. In the real world, it means spreading your money around. You invest in different kinds of companies, big and small, across different industries, even in different countries. That way, if one part of your investment portfolio takes a hit, another part might be doing great, which helps smooth out the whole ride. All right, so we've kind of mapped out the whole journey, haven't we? We've seen the potential treasure, we've marked the big dangers on the map, and now we have a playbook. So let's pull it all together and take one last look at the entire landscape. This little table here does a great job of summing it all up. Look at returns. The potential to beat inflation and get huge growth. The reality, no guarantees and crashes will happen. So what's your strategy? Invest for the long haul and don't panic. Now look at control. The potential, super easy access and you can get your cash out quick. The reality, you're going to deal with fees and volatility. So the strategy, research your broker and diversify. See how that works? Every part of the playbook is designed to fight a specific risk. When it all comes down to it, the main takeaway is this. This whole journey is yours, and your single most powerful tool is knowledge. Doing your own homework, really understanding what you're trying to achieve, and protecting yourself against those risks, well, that's the bedrock of smart investing. So, now you've got the map. You know the potential rewards, you know the real dangers, and you've got the strategies to navigate it all. The only question left is the one you have to answer for yourself. What's your investment story going to be?
Have you ever felt that pit in your stomach watching the stock market take a nosedive? Yeah, me too. Well, this is for you. Today, we are going to talk about taming that market risk. We're going to break down how the pros do it into simple, clear rules that anyone can use to invest with way more confidence.
I mean, let's be honest. We've all been there. You see the scary headlines, you see those charts bleeding red, and that little knot of anxiety just tightens up. You know, it's probably the single biggest fear that keeps good people on the sidelines, missing out on years of potential growth. But what if I told you that fear, while totally normal, is maybe focused on the wrong thing?
This right here, this is the most important mindset shift you can possibly make as an investor. See, the goal isn't to somehow magically avoid all risk. That's impossible. The real goal is to build a system to manage it. And that's exactly what we're going to do here. Give you that system so you can stop fearing the downturns and start preparing for them.
So where do we even begin with a system like that? Well, the foundation, the bedrock for everything else we're going to talk about starts with rule number 1. You have to play the long game. This is all about changing your perspective, right? It's about zooming out from the day-to-day chaos and looking at the bigger, clearer picture over decades. Okay, so this slide just lays it out perfectly. On the left, you've got short-term trading. It's really more like making high-stakes bets, reacting to every little market swing. That's why it's often called money you can afford to lose. But on the right, that's where we want to be, long-term investing. The goal here isn't to magically dodge the crashes, but to build a portfolio strong enough to weather them. Time becomes your best friend, smoothing out all that scary volatility and letting your returns compound.
And this quote, man, it just gets right to the heart of it. The market is going to fluctuate. That's a guarantee. The real mistake, the one that hurts people, is reacting emotionally and panic selling at the bottom. Playing the long game is about having the discipline to stay the course, trusting that, historically, the market always recovers and continues to grow.
All right, so you're on board with the long game. That's a huge first step. But what's next? Well, you got to make sure you're set up for success before you even put a single dollar in. And that brings us to rule number 2. You can't just invest, you have to investigate.
Now, this isn't about becoming a Wall Street analyst overnight. It's actually way simpler. It's about not letting unnecessary fees eat away at your returns. Think about it. Researching the platform itself is so important. Just take a look at a few different brokerages, compare what they charge you to buy and sell, and pick the one that costs you the least. It's such a simple move that will save you a ton of money over the long run.
So you've got a long-term mindset and a low-cost platform. Now you're ready for our third rule. This is probably the most famous principle in all of investing, and for really, really good reason. It's your best defense against the unknown.
You've heard it a million times, right? It's a classic because it's true. You just can't put all your eggs in one basket. I mean, imagine if your entire life savings were tied to one single company. If that company has a bad year, you're in serious trouble. But when you spread your money out, you build a kind of financial shock absorber. The wins in one area can help balance out the temporary losses in another.
So what does spreading it out actually look like? Well, here are 3 great ways to do it. You can diversify by asset class. That means mixing things like stocks for growth with bonds for stability. You can diversify by company size, so you have some big, steady companies and some smaller ones with more room to grow. And you can diversify geographically, having investments both here at home and internationally. Each of these is like adding another layer of protection to your portfolio.
So we've got the long game, investigating your platforms, and diversifying your assets. When you put all these powerful ideas together, they all fall under one big, important concept: doing your personal due diligence.
This is where it all comes back to you. At the end of the day, you are the one in charge of your financial future. It is absolutely critical that you do your homework before putting that hard-earned money to work. It's the work you do up front that protects you down the line. So think of this as your final checklist before you invest. First, understand the risks that actually apply to you. Someone about to retire has very different risks than someone just starting out. Second, make sure every investment actually makes sense for your goals. Are you saving for a house in 5 years or for retirement in 30? Those are totally different strategies. And finally, the golden rule that wraps it all up: do your homework and invest wisely.
So let's wrap it up with this. Armed with these principles, you're no longer just sitting on the sidelines hoping for the best. No way. You are now an active manager of your own money. So the next time you think about making an investment, what's the very first question you're going to ask yourself? Is it about the long-term potential? About how it fits into your portfolio? The power to ask the right questions? Well, that's now in your hands.
Hey everyone, welcome. Today we're going to tackle a big one, how to actually get started in the stock market. We're going to strip away all the confusing jargon and give you a super clear step-by-step plan. So, let's just jump right in. So, does that sound familiar? If you've ever felt that way, trust me, you are not alone. It can seem incredibly complicated, almost like it's a club for insiders only. But I promise you, by the end of this, you're going to see that it is so much more accessible than you think. We're going to break it all down into simple, manageable steps. So let's start at square one. What are we even talking about here? At its absolute core, investing in stocks is just this. You're buying a tiny piece of a company, a little slice of ownership, and those little slices are called shares. The whole idea is that the company does well, its value goes up, and then your shares are worth more than what you paid for them. That's it. That's the game. All right, so here's our game plan for today. We've already covered what stock investing is. Next, we'll look at your 3 main investing paths. Then we'll explain the huge difference between stocks and funds. After that, we'll talk about budgeting to get started, and we'll wrap up with what might be the most important part, the successful investor's mindset. Okay, let's get into it. The very first decision you need to make isn't what to buy, but how you're going to invest. And this really just boils down to one simple question. How hands-on do you want to be? So you've basically got 3 main roads you can go down. First up, there's the do-it-yourself route. We'll call that the DIY investor. You're in the driver's seat picking everything yourself. Second, you've got the managed path, where you hand the keys over to a human expert or, more commonly these days, a robo-advisor. And third, there's the path a lot of people start on, which is through your job's retirement plan, like a 401k. That's often the easiest way to begin. Now, if you're not going through an employer plan, your choice is usually going to come down to one of these 2. On the one hand, you have the DIY brokerage account. This gives you total control, which is great, but it also means you're doing all the homework. On the other hand, you have a robo-advisor. This is a totally hands-off approach. You just answer a few questions about your goals, and its computer algorithm builds and manages a whole portfolio for you. It's amazing, but it does come with a small management fee. So it really boils down to this, a trade-off between control and convenience. Okay, so you've picked your path, you know how you want to invest. Now we get to the big question, what do you actually buy? And this right here is probably the single most important concept for a new investor to really get their head around. You've got 2 main choices. You can buy individual stocks, which means you're putting your money on a single company, or you can buy a fund. Now, a fund is like buying a whole basket full of different stocks all at once. Think about the risk here. Putting all your eggs in one basket with one company is high risk, but yeah, potentially high reward. Buying a fund, on the other hand, automatically spreads your risk out across many companies. That's called diversification, and believe me, it is your best friend as an investor. So let's just hammer this point home. For pretty much every beginner, funds are the way to go. Why? Well, you get instant diversification, which means lower risk. They are often incredibly low cost, especially types like index funds and ETFs. And honestly, they're just so much simpler. This is what most financial advisors recommend for a reason. All right, let's talk about the big one. The question that stops so many people in their tracks before they even start, the money. There is this huge myth out there that you need a ton of cash to even think about investing. Let's just bust that myth right here, right now. I mean, seriously, what's the cover charge to get into this club? Do you need thousands of dollars? Hundreds? What does it really take to buy your very first investment? The answer is, well, it's surprisingly simple and a lot less than you think. For many of those funds we just talked about, especially ETFs, you can get started for just the price of a single share, and that can often be less than $100. You don't need a fortune to start building one, you just need to start. Okay, we have covered the nuts and bolts, the how-to. Now let's talk about the how to think. And honestly, this might be the most valuable part of this whole explainer, because having the right mindset is what separates people who succeed at this from, well, everyone else. So what's up with this number, 10%? Well, historically, that's been the average annual return of the U.S. stock market over many, many decades. Now, some years are way up, some years are down, but over time, that's the kind of growth you're tapping into. But the key words there, and I can't stress this enough, are over time. We're playing the long game here. Look, a lot of people think successful investing is about finding some secret formula or some complex strategy. It's not. It's really just about sticking to the basics. It's about being patient, being consistent, and not getting rattled by all the day-to-day noise. And hey, don't just take my word for it. Listen to a guy who knows a thing or two about this stuff, Warren Buffett. maybe the most successful investor of all time, has said for years that a simple, cheap fund that just tracks the 500 biggest US companies is the best bet for most people. Simple, not complicated. So let's get super practical. Here are the rules of the road. First, think in decades, not days. Don't invest any money you think you might need in the next 5 years. Second, please, do not obsess over the daily changes. Put the phone down. It will drive you crazy. Third, put it on autopilot. Set up small, regular, automatic contributions. And finally, just check in maybe once a year just to make sure everything's still on track. So if you only remember one single thing from our time together today, please make it this. Investing just is not as complicated as it seems. With things like low-cost funds and robo-advisors, it has never, ever been easier to get started. You do not need to be an expert to do this. So there you have it. You have the roadmap, you know the mindset, you've seen the tools. The only question left is, what's your first step going to be? Thanks so much for watching. Good luck. All right, so you're thinking about getting into the stock market. You really got two main paths you can go down. Are you going to play the long game with a steady, proven strategy, or are you here for the thrill of chasing that next big winner? It's a huge question, so let's break it down. Now, for a lot of people just starting out, let's be real, it's the dream of finding the next Amazon or Tesla that gets you excited. I mean, that adrenaline rush, picking a single stock, watching it just take off, that feeling that you've totally outsmarted the market, yeah, that's a really powerful pull. But okay, here comes the reality check. This quote right here gets to the heart of it. It says that if you're really looking for that thrill, well, safe and reliable investments, like index funds, they're probably not going to give it to you. And that right there sets up the two totally different paths we're about to dive into. The steady, proven strategy versus that high-stakes chase. Okay, so let's start with the exciting path, right? The one that really feels like you're in the driver's seat. We're talking about active trading, and it's honestly where a ton of new investors just naturally gravitate. And you know what? That desire makes perfect sense. It's all about wanting to be in control, right? Believing you can actually outsmart the market, find that hidden gem before anybody else does. It's basically like a financial treasure hunt. But the big question is this high-energy approach really the best move for a beginner? Or is there a more reliable way to go? Well, to figure that out, let's put it head-to-head with its total opposite. Okay, now we're getting to the core of it. Trading versus investing. Let's really break down the key differences here, because honestly, these two philosophies are pretty much polar opposites. So think of stock trading like a sprint. It takes a ton of effort, you have to do constant research, and you're chasing this almost impossible goal of timing the market perfectly. It's really a game best left for the experts. But then you've got buy and hold investing, and that's the marathon. It's all about patience, spreading your money out through diversification, and just aiming for long-term growth. And that, right there, makes it a way better fit for beginners. But here's the interesting thing. Here's the twist. Even with these huge differences in how you approach it, the ultimate goal, it's exactly the same. Yeah, at the end of the day, it all boils down to one simple thing. Buy low and sell high. I mean, whether you're a frantic day trader or a patient long-term investor, that's the name of the game. So the real question isn't what you're trying to do, it's how you're going to try to get there. So, keeping that common goal in mind, what does history actually show us is the most reliable way to pull it off, especially if you're just getting your feet wet? All right, when we look at the most effective and, reliable strategy for new investors, the advice is super clear and direct. It's all about building a really solid foundation. And the cornerstone of that whole strategy, it's diversification. So just think about something like an S&P 500 index fund. Instead of betting all your money on just one horse, it's like you're betting on 500 of the biggest, strongest horses in the entire race. That one simple move just dramatically spreads out your risk. So the recommended approach really boils down to this. Use those diversified funds, get into a buy and hold mindset for the long term, and you've got to resist that urge to be constantly trading. Just let diversification do all the heavy lifting for you over time. Seriously. But let's be honest here. What about that thrill we talked about in the beginning? What if you still really want to try your hand at picking a few stocks yourself? Well, the good news is you don't actually have to choose. There's a pretty brilliant compromise that lets you have the best of both worlds. You get that solid, safe foundation with a little bit of room left over to experiment. So here's the strategy. You dedicate 90% or even more of your portfolio to those stable, diversified funds. That's your core. That's the foundation. Then, with that little bit left over, that 10% or less, you can scratch that itch and go ahead and experiment with some individual stock picks. And this 10% rule, that's the whole key. By putting a cap on your more speculative picks, you get to experience that thrill of the hunt, but you're not putting your entire financial future on the line. It's just a really smart, disciplined way to get the best of both worlds. Ultimately, figuring out the right path for you really just comes down to a moment of self-reflection. You gotta understand your own motivations. Why are you even investing in the first place? So the final question you really need to ask yourself is this. Are you here for the thrill of the trade, or are you here to build a solid foundation for your future? Your answer to that question, well, that's what's going to determine your path. So when it comes to the stock market, there's this one piece of advice pretty much everyone knows. It's super simple, it's catchy, and honestly, it sounds like a guaranteed win. You've heard it a million times, right? Buy low and sell high. It's like the golden rule, the first thing anyone ever tells you about investing. It's the absolute core idea of how you make a profit. But what if I told you that simple phrase barely even scratches the surface? That really winning in the market isn't about following one single rule, but about finding a whole philosophy that actually fits you. Okay, so let's dive in. In this explainer, we're going to break down 4 really distinct mindsets for investing. We'll look at how each one works, who it might be for, and of course, the unique risks and rewards that come with them. First up, we've got a classic showdown. Now, this philosophy is all about one thing: finding and buying great companies. But the definition of what makes a company great is where things start to get really interesting. So let's break this down, because you're really looking at 2 sides of the same coin here. On one side, you've got value investing. You can think of this as bargain hunting for stocks. You're searching for these solid, established companies that the market has, for whatever reason, kind of overlooked. And you often spot them with a low price to earnings, or PE ratio. It's basically just a quick way to see how expensive a stock is compared to its profits. A low PE could mean you found a bargain. Then, on the other side, you've got growth investing. This is more like unicorn hunting. You're betting on these new, emerging companies with groundbreaking tech and high profit margins, really hoping to catch the next big thing before it goes nuclear. And yeah, that chase for the unicorn, it's incredibly seductive, isn't it? The promise of getting in on the ground floor of some world-changing technology is just so powerful. A perfect and pretty cautionary example of this is the story of Theranos. At its peak back in 2014, Theranos was valued at a staggering $9 billion. Investors just poured money into it, completely captivated by the promise of a technology that could change blood testing forever. It was the ultimate unicorn, and everybody wanted a piece of that action. And this is where it all fell apart. It perfectly illustrates the risk. The groundbreaking tech? It was a complete sham. The company totally collapsed, and investors lost over $600 million. So what this really drives home is that while growth investing offers this incredible upside, the potential for a catastrophic downside is just as real. Okay, let's switch gears and move to our second philosophy. This one takes a completely different angle. This isn't about chasing explosive growth. It's about building a machine that just pays you. So this is what we call income investing. The goal here is pretty simple. You want to create a steady, reliable stream of cash flow from your assets. You're not just buying stocks and hoping they go up. No, you're buying assets that will generate regular payments. A good way to think about it is like you're being a landlord for your money. You want it working for you, paying you rent in the form of dividends or interest. Now, to really get the trade-off here, let's look at this amazing story of Lauren and Kelly. Back in 1997, Kelly invested in Coca-Cola, a classic income stock, right? Known for being stable, paying reliable dividends. Her friend Lauren, though, took a much bigger risk. She invested a similar amount of money in this new online bookstore called Amazon. For 22 years, Kelly collected her dividends. Nice, steady income. But Lauren? Well, she was playing a totally different game. And here's the punchline. When they both sold their stock in 2019, Kelly had made a modest capital profit of just under $2,000, plus all those dividends she collected over the years. Lauren, on the other hand, made over $1.6 million just from the stock's growth alone. This story just perfectly captures that fundamental choice. Do you want the comfort of steady income, or the life-changing potential of capital growth. All right, time to shift gears dramatically. Our third philosophy leaves that whole long-term holding idea in the dust and enters the super fast-paced world of daily market moves. This is the world of trading. Day trading is a completely different beast. It's not a side hustle, it's a full-time job. It demands your constant attention, tons of research, and just extreme emotional discipline. You're not investing in a company's future anymore, you're betting on tiny price movements that happen minute by minute. This isn't about believing in a mission, it's about executing a strategy with absolute precision, almost like a professional athlete. It really requires a specific kind of personality, someone who thrives on high stress and can make cold, logical decisions under insane pressure. Now, inside this crazy high-stakes world, there's a fascinating strategy that just flips that whole buy low, sell high idea on its head. It's called short selling, and it's how you can actually make money when a stock's price goes down. Yeah, you heard that right. You're essentially betting on a company to fail. So, how does that even work? It sounds kind of strange, right? Let's walk through it slowly. Step 1. You borrow shares from a broker and you pay them a little fee for the loan. 2. You immediately sell those shares you just borrowed on the open market at their current higher price. 3. You wait. This is the whole game right here. If your research was good and the stock price falls, you go to step 4. You buy the same number of shares back, but now at the new, much cheaper price. And finally, step 5. You return those shares to the broker you borrowed them from, and you get to keep the difference. That's your profit. It's a complex, definitely high-risk strategy, but it's for traders who are really confident a company is overvalued. Okay, let's move on to our final philosophy, and this is one that has gained incredible momentum in recent years. This approach argues that your investments can do more than just make you money. They can actually make a difference. You know, this whole space has a lot of confusing acronyms, so let's just clear things up real quick. Impact investing is about proactively funding companies that create a measurable, positive impact in the world. Then there's ESG. That stands for environmental, social, and governance. It's really more of a risk management tool using these factors to find financially strong companies. And finally, there's SRI, or socially responsible investing. That usually involves using screens to actively exclude companies involved in things you might not like, say tobacco or weapons, based on your own ethical guidelines. But here's the big question. Does investing with your conscience mean you have to sacrifice returns? Well, not necessarily. According to a major 2020 survey by the Global Impact Investing Network, a huge majority, we're talking 88% of impact investors, reported that their investments either met or actually exceeded their financial expectations. And you know, this whole trend is being driven in a big way by younger investors, like millennials, who really want their financial decisions to line up with their personal values. What's important to get here is that this isn't just some niche strategy anymore. It's a growing movement that's really reshaping how we think about the purpose of money. So let's pull this all together for a quick recap. We've got the company detective out there hunting for value or growth. We have the portfolio landlord building that steady cash flow machine. Then there's the market sprinter, playing the high-stakes game of short-term trading. And finally, we have the principled visionary, who's looking for both a financial and a social return. But you gotta remember, these are just frameworks. They're not prisons. The most sophisticated investors, they rarely stick to just one. You might find a value investor who also holds a few income stocks, or a growth investor who makes sure their companies meet certain ethical standards. The real key is to understand the principles behind each one. And that really brings us to the final question, the one that truly matters. When you look at these 4 mindsets, which one speaks to you? What are you trying to accomplish? How much time do you have? And maybe most importantly, what do you really value? The answer to that is the real beginning of your own investment journey.
All right, today we're going to tackle one of the most talked about and maybe least understood concepts in the market: volatility. But we're not just going to give you a dry definition. Nope, we're going to see it in action through the wild, wild ride of small cap stocks.
You hear that word volatility tossed around all the time, right? Especially when the market gets a little shaky. But what does it actually look like? What does it feel like? Forget the textbook for a minute, because we're about to walk through a real-world story that just brings this whole idea to life.
So, welcome to what we're calling the small cap roller coaster. Now, small cap stocks, we're talking shares in smaller companies here. They're kind of famous for their big swings. One minute, you're plunging, the next, you're soaring sky high.
It's a ride that really tests your nerve. To really see this roller coaster do its thing, we're going to zoom in on a specific period and look at two major small-cap indexes, the Russell 2000 and the S&P 600. These guys track hundreds of smaller U.S. companies, and believe me, their story is a fascinating one.
You know how every great roller coaster has that first big stomach-in-your-throat drop? Well, for small caps, that moment was a truly dramatic downturn that had a lot of people sweating.
So, picture this. Small cap stocks had just hit a peak back in August. Everything's looking great. And then the market turned. Both of these indexes started to fall. And I mean, they didn't just dip a little bit. They took a serious nosedive.
And here it is, the big number, a 20% drop from those highs in August for both the Russell 2000 and the S&P 600. A full fifth of their value, just gone. I mean, that is a significant and, let's be honest, pretty frightening fall.
Now, a drop like that, it does things to your head. Panic starts to creep in. And just as our source material points out, a lot of investors saw that 20% decline and thought, that's it. It's confirmation of a bear market. They figured the party was officially over.
But hold on, this is a roller coaster, remember? And what happens after that terrifying drop? You get that exhilarating climb back up. Just when it seemed like all hope was lost, the market did a complete 180.
Yeah, that disastrous period we just talked about, it was followed by an absolutely incredible rally. The very same stocks that had just been plummeting started soaring back with some serious strength. It was pretty surprising. And just look at how powerful this comeback was. During this rebound, the S&P 500, the big benchmark for the whole U.S. market, it gained a respectable 9%. Not bad. But our small cap index, the S&P 600, it jumped 12.1%. So it didn't just recover, it actually outperformed the broader market. Wow.
Okay, we've seen the brutal drop. We've seen the stunning recovery. So what's the final verdict here? What's the big lesson from this wild ride?
This brings us right back to our key term. Now that we've actually seen it happen, this definition of volatility makes so much more sense, doesn't it? It's the tendency for big, fast swings in price, not just down, but, and this is crucial, in both directions.
This quote from our source material really just nails it. This entire episode, from the plunge all the way to the rally, it emphasizes the more volatile nature of small caps. This isn't some weird one-off event. This is what they do. It's a core characteristic. So if there's one thing to really burn into your brain, it's this. This is what volatility looks like. It's not just the scary 20% drop. It's also the amazing 12.1% rally that came right after. It's the full swing of the pendulum, the entire journey down and back up that truly defines the concept.
And that leaves us with one last, really important question to think about. After seeing all this, is volatility just a massive risk that you should run away from? Or is it simply a feature of the market, a force that, if you take the time to understand it, might actually present its own unique opportunities? Something to chew on.
So you're thinking about investing? That's awesome. It's one of the best ways to build real wealth. But let's be honest, for anyone just starting out, it can feel like a minefield. It's super easy to make mistakes that can cost you. So in this explainer, we're going to walk through the most common traps and, more importantly, how you can dodge them from day one. So, really? Think you're ready to invest? That's the big question, right? Before you dive headfirst into the market, it's so important to take a quick pause and just check if your financial house is in order. Being ready isn't just about having some cash to throw around. It's about building on a solid foundation. Okay, so here's our game plan. We've broken this down into a 5-part journey. We'll start with the basics, laying the foundation. Then we'll get into making your first investments. We'll cover those common trading pitfalls to avoid, talk about managing your portfolio for the long haul, and finally, get into mastering your own mindset. Let's do this. First up, laying the foundation. And this is all about what you need to do before you invest a single dollar. Seriously, success in the market often starts with the smart moves you make completely outside of it. Okay, here they are. 2 absolute non-negotiables. First, you've got to pay off any high-interest debt. Think credit cards. The return you get from wiping out that debt is pretty much guaranteed, and it's almost always going to be higher than what you can expect from the stock market. Second, build up an emergency fund. We're talking 6 to 12 months of living expenses. Why is this so crucial? Well, this little stash of cash is what saves you from having to sell your investments at the absolute worst time, like, say, during a market crash, just because your car broke down. And this right here, this is a huge mindset shift. It is so tempting to chase those fast profits you hear about. But the reality? Building wealth is a marathon, not a sprint. It takes years. The source material points out that very, very few stocks actually keep up yields over 20% for the long run. Real success comes from patience and just steady, consistent progress. All right, so you've got your foundation in place. Awesome. Now you're ready to actually make your first investments. This next part is all about making smart choices right out of the gate and not falling for those classic rookie mistakes. So who do you listen to? Honestly, the best answer is yourself, but only after you've put in the work. You know those hot stock tips from your buddy at work or those crazy headlines in the financial news? They're super tempting, but they're usually just noise. That old saying, if it sounds too good to be true, it probably is. Yeah, that's like rule number 1 in investing. There's just no substitute for rolling up your sleeves and doing your own research. And this is the golden rule for sure. Before you buy even one share of a company, you should be able to explain in simple terms how they make money. What's their edge? What are the biggest risks they're facing? Are their finances actually solid? If you can't answer those questions, you're not really investing. You're just gambling. Okay, here's a super simple, practical tip that'll save you money. Trading commissions, those are the fees you pay your broker every time you buy or sell, can seriously eat into your profits, especially when you're starting out with smaller amounts. So here's the bottom line. Try to make sure those fees are never more than 2% of your total trade. It's a small thing that makes a big difference. Which brings us right to our next section, common trading pitfalls. It's really easy to think that being an active investor means you have to be buying and selling all the time. But as we're about to see, being too active is actually one of the fastest ways to lose your shirt. And hey, don't just take my word for it. This is a direct quote, a warning from the U.S. Securities and Exchange Commission. The whole idea of day trading sounds exciting, right? But the numbers don't lie. Most people who try it end up losing a lot of money. That's not just an opinion. That's a well-documented fact. And besides the huge risk of just losing money, trading a lot has another big downside: taxes. Yep. So here's how it works. If you buy a stock and then sell it less than a year later, any profit you make is a short-term capital gain. That gets taxed at your normal higher income tax rate. But if you hold on to that same stock for more than a year, it becomes a long-term capital gain, and that gets taxed at a much, much lower rate. It's basically a massive financial incentive to just be patient and think long-term. All right, let's talk about penny stocks for a second. New investors often get lured in by these because they think, wow, I can buy thousands of shares. But that super low price tag, it's not a bargain. It's a warning sign. These stocks are usually tied to companies that aren't profitable or are just super sketchy. They're incredibly risky and a playground for scams. Just steer clear. Okay, so now that we know what not to do, let's talk about the right way to manage your portfolio over the long run. This is all about discipline, having a strategy, and playing the long game. We all hear the word diversification thrown around, but what does it actually mean? Well, it's not just about owning a bunch of stocks. I mean, if you own 20 different tech companies, guess what? You're not diversified. True diversification is about spreading your money across different types of industries and sectors, because they all react differently to what's happening in the economy. So, for example, when interest rates go up, high-flying tech stocks might take a hit, but financial stocks, like banks, could actually do well. See? The whole point is that a storm in one part of the market won't sink your entire ship. Okay, let's talk about a concept called rebalancing. So imagine this. You start out with a portfolio that's 75% stocks and 25% bonds. This is your target mix, the one that perfectly matches how much risk you're comfortable with. Now, let's fast forward 5 years. Your stocks have done really, really well. That's great. But now your portfolio has drifted and is sitting at 90% stocks and only 10% bonds. So even though you've made money, you've also accidentally taken on a ton more risk than you originally signed up for. So what's the fix? It's simple. You rebalance. All that means is that every so often, you sell a little bit of your winning investments and use that cash to buy more of the ones that have fallen behind. This brings you right back to your original 75-25 split. It's just a disciplined, automatic way to manage risk and lock in some of your gains along the way. And that brings us to our final and maybe the most important section of all, mastering your own mindset. You can have the world's best strategy, but if your psychology isn't in check, you can still end up with terrible results. It's a really simple question, but it's a powerful one. Are your feelings controlling your finances? Because in the world of investing, the two biggest emotions are greed and fear. And honestly, they're responsible for more money lost than pretty much anything else. And here you can see exactly how those emotions lead us astray. Greed is what makes you jump on a hot stock right when it's at its peak. Fear is what makes you sell everything in a panic when the market drops, locking in your losses for good. And then there's that stubborn feeling of just wanting to break even on a losing stock, which traps your money and stops you from finding a better opportunity. The goal always is to be rational, not emotional. So what's the best weapon against making emotional decisions? Knowledge. The more you learn about the companies you own, about the economy, about different investment strategies, the more confident you'll become in your plan. You'll be way less likely to panic during a downturn because you actually understand the bigger picture. The best investors, they never ever stop learning. So we want to leave you with this question. After walking through this whole journey, what's the very first tangible step you're going to take to become a smarter investor? Maybe it's paying down that credit card. Or maybe it's starting to research your first index fund. Or maybe it's just committing to reading one financial report a week. Whatever it is, taking that first deliberate step, that's what turns a novice into a successful investor for life.
All right, so here we are, the final chapter of your training. You've soaked up all the strategies, and now you're basically standing at the doorway to your new life as an investor. But hang on, before you step through, there is one last, absolutely critical lesson we need to cover.
You can almost taste it, can't you? Those untold profits. You've got the knowledge, you've got the tools, and you're ready for what feels like a thrilling ride. But there's a hidden trap here, a trap that gets almost every new investor. And I'm here to make sure you sidestep it completely.
And boom, there it is. The single biggest threat to your success isn't some crazy market crash or picking a bad stock. Nope, it's you. It's that moment when you start winning, when you start to succeed and you think, hey, I can ease up a bit. That right there, that's the trap that separates the amateurs from the true geniuses.
So let's call this what it is, the new investor's trap. It's this weird, dangerous mental shift where your first few wins actually become the very reason you might fail down the road. Let's really dig into how this happens. I mean, it's just human nature, right? You make a couple of great trades, you see your account balance looking healthy, and that little voice in your head pipes up. It says, see, you got this. You don't really need to do all that homework anymore. You start getting a little loose with the fundamentals, and that's the exact moment things can start to unravel.
So here's the bottom line. Winning in the long run isn't about getting lucky or hitting a hot streak. It's all about discipline. It's about having a plan, a strategy that you stick to, especially when things are going great. That's your anchor. That's what keeps you on the right path when that feeling of complacency tries to pull you off course.
So how do you actually stay the course? Well, think of what we're about to cover as your mentor's personal toolkit. These are the fundamental guidelines pulled straight from the source material, and they are designed specifically to keep your head on straight and your strategy sharp.
Okay, so check these out. What's amazing is how simple these core principles are, but you wouldn't believe how often people just ignore them. Think of them as 5 shields to protect you from yourself. First, you got to separate your logic from your feelings. No fear, no greed. Second, spread your money around, diversify, so one bad investment doesn't wreck everything. Third, and this is huge, know when you're going to sell before you even buy. And the last 2 are all about protecting your cash from those silent killers, taxes and fees. If you can master these 5, you've honestly won half the battle already.
Now, I know what you might be thinking. Wait a minute, you just told me to stick to a plan. And you're right, but this isn't a contradiction. A good strategy actually has a little room built in for some calculated risks. You can set aside a small piece of your portfolio just for experimenting, for learning. It keeps you sharp, helps you find new things, and you can do it all without betting the house. Let's just be crystal clear about this. You will fail. You're going to make bad trades. You're going to lose some money. It happens to literally everyone. The genius isn't the person who never fails. The genius is the one who learns a lesson from it and gets right back up. Think of failure as just paying tuition at the University of the stock market. And that right there, that's the key to moving forward. When a trade doesn't go your way, you don't freak out. You just zoom out and remember your long-term goals. Why are you doing this? Retirement? Financial independence? Whatever it is, that's your North Star. It keeps you focused on building a portfolio that's going to keep growing long after you've forgotten about any single loss.
Okay, let's shift gears to the next idea. And seriously, this one is a game changer. You can memorize every single rule, read a mountain of books, and understand every concept inside and out, but that knowledge is totally worthless if you don't act on it. There's a massive difference between knowing the path and actually walking the path.
I mean, think about it this way. You can't learn how to swim from a book, right? You could read about buoyancy and different strokes all day, but the second you actually get in the water, all that theory goes out the window.
It's the exact same thing with driving a car. You can ace the written test, know every single traffic law, but that doesn't prepare you for merging onto a busy highway during rush hour. Mastery only comes when you get behind the wheel.
And you're never going to become a great artist by just studying the masters in a museum. Skill comes from putting that brush on the canvas over and over and over again. Well, the market, that's your canvas.
So what do all those things, swimming, driving, painting, what do they all point to? It's one simple, powerful truth. Practice. Not just thinking about it, not just reading about it, but actually doing it. Placing trades, managing your money, analyzing what worked and what didn't. That is the one and only true key to success.
And that brings us right to our final section here. The books are closed, the lessons are over, the real journey, the actual process of becoming a market genius, it starts right now.
You know, the single most dangerous thought an investor can ever have is, I've got this all figured out. The markets are always changing, new technologies pop up, the world shifts. You have to commit right now to being a student for life. Your education didn't just end, it actually just began.
And this is the promise. This is what should keep you going. All the effort you're putting in now, all the research, the discipline, pushing through the failures, you're just sowing seeds. And down the line, the harvest you're going to reap, well, the potential rewards are bigger than you can even imagine right now.
And so, we're at the end. The final instruction is also the most important one. It's time to stop just taking in information and start actually applying it. The training wheels are officially off. It's time to put all of these principles into action. So I'm just going to leave you with this. You've got the principles. You know about the traps to avoid. You understand that practice is everything. The only question left is the one right there on the screen. Are you ready to act? The journey is all yours. Go get it.